or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 190, and in this episode we are reviewing the performance of the financial markets during the 50th week of 2025, and that is from Monday the 8th to Friday the 12th of December. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the Federal Reserve, which was widely expected to cut its policy rate this past week, delivered on market expectations, but remained divided in its decision-making as it signaled some reluctance to continue cutting interest rates. Fulfilling market expectations for a hawkish rate cut, the Federal Open Market Committee lowered its key overnight borrowing rate by 0.25 percentage point, taking it to a range of between 3.5% to 3.75%. The committee voted 9-3 in favor of the rate cut, with 3 members voting against this decision, which featured both hawkish and dovish commentary. In Fed parlance, hawks refer to officials who are more concerned about inflation and favor higher interest rates, whilst doves tend to focus on supporting the labor market and prefer lower interest rates. The Fed chairman, Jerome Powell, in his post-meeting news conference, said that the reduction in rates puts the Fed in a comfortable position as they wait to see how the U.S. economy will perform. On the economic front, the committee raised its collective outlook for economic growth to 2.3% in 2026 and continues to expect inflation to hold above its 2% target rate until sometime in 2028. On Wall Street this past week, U.S. equities pulled back on Friday as investors continue to exit technology stocks and move into value stocks whose performance is tied to economic growth. After the Federal Reserve cut interest rates on Wednesday, the stock market moved into the rotation trade, which saw investors selling shares in growth-oriented companies that are associated with the artificial intelligence trade and buying into cyclical stocks that are considered more sensitive to the economy. The broad market S&P 500 recorded a weekly loss as it fell by 0.6% to close at 6,827, whilst the tech-heavy Nasdaq Composite declined by 1.6% to end the week at 23,195. And in contrast, the 30-stock Dow Jones Industrial Average went against the grain as it gained by 1.1% during the week before settling at 48,458. In the government bond market, the yield on the 10-year Treasury bond surged on Friday after the Chicago Fed president warned against a further reduction in interest rates just soon after the Fed cut its policy rate on Wednesday. Separately, in a formal statement that was released on Friday, the Chicago Fed president said that policymakers should have waited for more data before issuing more rate cuts. Bond investors are trying to assess the future direction of monetary policy in 2026, especially after Powell's term as Fed chairman comes to an end in May 2026, and as President Trump seeks to replace him with a more dovish chairman who would be more aggressive in cutting interest rates. The Fed has a delicate balancing act of managing between a low and stable inflation whilst at the same time delivering on maximum employment. The balance of opinion on Wall Street is converging around the idea that if the labor market remains weak, then the Federal Reserve will be more inclined to cut interest rates even further. The yield on the short-dated 2-year Treasury note fell by less than 1 basis point to 3.52%, whilst the yield on the benchmark 10-year Treasury bond rose by more than 4 basis points to 4.18%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil inched lower on Friday, posting a weekly decline as investors focused on a supply glut and a potential peace deal between Russia and Ukraine on the back of concerns about disruptions of oil supply from Venezuela. Rising tensions between the U.S. and Venezuela continues to prop up the price of oil as the U.S. prepares to intercept more ships transporting Venezuelan crude. The focus, however, remains on the supply glut in the market as the price of both benchmarks lost more than 4% this past week, reflecting broader market uncertainties. The price of the global benchmark Brent crude closed for trade at $61.12 a barrel, whilst the price of the U.S. benchmark West Texas Intermediate settled at $57.44 per barrel. In the precious metals market, the focus in the metals market shifted from gold to silver this past week as the price of silver hit an all-time high on Friday, whilst the price of gold rose to a 7-week peak. The Federal Reserve announced its third and final rate cut for this year, but signaled caution on further rate cuts until more data is available. Investors are currently pricing in at least 2 rate cuts in 2026 and are awaiting the release of the non-farm payrolls report this coming week in order to get a better picture of the state of the U.S. economy. Silver prices were up nearly 5% for the week and have gained about 112% so far this year, spurred by tightening inventories, sustained industrial demand, and its inclusion on the U.S. critical minerals list. The price of spot silver hit a record high of $64.64 earlier in the session before correcting by about 3% to close the week at $61.70 per ounce. Meanwhile, the price of spot gold hit its highest level since October 21st as it came to a close at $4,293 per ounce. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where the Kenya shilling appreciated marginally versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at a rate of 129.16 compared to a rate of 129.41 the previous week. Meanwhile, the sterling pound was priced at 172.64 and the euro was valued at 150.98. And on the regional front, one Kenyan shilling was changing hands for 27.66 Ugandan shillings and 18.97 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.27. The IMF has raised concerns about the stability of the Kenya shilling, but the central bank confirms that it continues to adopt a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased marginally by $35 million for a grand total of $12.06 billion, which is equivalent to 5.2 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate declined from 9.24% the previous week down to 9.05%, which is in line with the new central bank rate at 9% flat. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 13 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 11th of December, and the central bank received bids totaling to 32.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 135%. The central bank ended up accepting 31.6 billion shillings, and the results of the auction were as follows. The 91-day rate was static at 7.77%, whilst the 182-day rate was stable at 7.80%, and the 364-day rate declined by about 13 basis points to average out at 9.23%. In the primary bond market, the Central Bank of Kenya has published its prospectus for its January 2026 bond issue and is now inviting bids from the public. The central bank is looking to raise a total of 60 billion shillings through the sale of 2 reopened fixed coupon treasury bonds whose terms and conditions are as follows. The first bond is a 20-year bond that was initially issued in 2019 and now has 13.2 years left to maturity. This bond has a coupon rate at 12.87%. The second bond is a 25-year bond that was initially issued in 2022 and now has 21.8 years left to maturity. This bond has a coupon rate at 10% flat. Please note that the interest accrued on these bonds is subject to withholding tax at a rate of 10%, and these bonds are now open for sale until Wednesday, the 7th of January 2026, when the auction will be held. In the corporate bond market, in November 2025, Safaricom announced that it was looking to raise a total of 40 billion shillings through the issuance of a medium-term note for the purpose of financing and refinancing green projects. Safaricom was able to raise a total of 20 billion shillings from the first tranche of its corporate bond, which came to a close on Friday this past week. Safaricom was initially looking to raise a total of 15 billion shillings, but ended up receiving bids totaling to 41.6 billion shillings, representing a subscription rate of 177%. This oversubscription presented an opportunity for the company to exercise the green shoe option, in which it opted to take up an additional 5 billion shillings, bringing the total amount raised to 20 billion shillings. Successful investors in this first tranche have been able to lock in a fixed interest rate of 10.4% for the next 5 years, that is until December 2030. This offer by Safaricom represents the largest corporate bond issuance at the Nairobi Securities Exchange and has revitalized the corporate debt market, following soon after East African breweries raised 16.7 billion shillings from the market. And in other news, investment bank Dyer & Blair and stock brokerage firm Francis Drummond have been picked to guide the initial public offering of the Kenya Pipeline Company, in which the government is looking to raise a total of 100 billion shillings from the sale of a 65% stake in the parastatal. Sources have confirmed the selection of the two market intermediaries to facilitate the floating of Kenya Pipeline shares on the Nairobi Securities Exchange in the first quarter of 2026. Dyer & Blair has been selected as the lead stockbroker, whilst Francis Drummond has been appointed as the co-sponsoring broker for the initial public offering. And in the headlines this past week, the Central Bank of Kenya announced the launch of the National Financial Inclusion Strategy for 2025 to 2028, together with the fourth medium-term plan for the financial services sector, and also the signing of the Women Entrepreneurs Finance Code. These three policy frameworks are expected to provide a strong foundation for the transformation of Kenya's financial sector. The National Financial Inclusion Strategy seeks to enhance equitable access to affordable financial products and services, and for the same to be delivered in a sustainable way that is convenient for customers. Up next is our topical issue, and this week we are looking at the policy decision by the Central Bank's Monetary Policy Committee. The Central Bank's Monetary Policy Committee held its meeting on Tuesday, the 9th of December, and during its deliberations, the committee made the following observations. Global growth has remained resilient and is projected at 3.2% in 2025, supported by improved financial conditions and strong consumer and business spending. Meanwhile, central banks in the major economies have continued to ease monetary policy as inflation has eased slightly but remains above the target policy rates. Global inflation is projected to decline in 2026, mainly driven by lower energy prices and reduced global demand. Back at home, Kenya's overall rate of inflation declined to 4.5% in November 2025 and remained below the midpoint of the central bank's target range. Overall inflation is expected to remain stable in the short term, supported by lower food and energy prices and the continued stability of the dollar-shilling exchange rate. The performance of the Kenyan economy remained resilient in the first half of 2025, with real GDP growth averaging 4.9%, supported by stable growth in the agriculture sector and resilience in the services sector. As for the banking sector, this remained stable and resilient with strong liquidity and capital adequacy ratios, as the percentage of gross non-performing loans declined slightly to 16.5% in November 2025. The committee noted that the revised risk-based credit pricing model, which will be fully operational by March 2026, will help to improve the transmission of monetary policy by commercial banks. Meanwhile, private sector credit, which measures the growth in loans and advances to the private sector, this continued to register improved growth from 5.9% in October to 6.3% in November. Having considered the above developments, the Monetary Policy Committee concluded that there was scope for a further easing of monetary policy and therefore decided to lower the central bank rate by 25 basis points from 9.25% down to 9% flat. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, don't go where the path may lead. Go instead where there is no path and leave a trail. A quote by Ralph Waldo Emerson. Think about it. Thank you, and God bless.